Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. In this presentation, we are going to look at MACD technical indicator or analysis for stocks and bonds. MACD simply refers to moving averages, convergence, divergence indicator. It can help us identify opportunities across financial markets, be it stocks, bonds, options, futures, you name it. It will help us to identify buy opportunities, hold opportunities, and opportunities to sell signals. Let us focus on the fundamentals before we actually look at a chart like this, which is actually QQQ up-to-date chart. And as I said, this is the actual QQQ chart as of last week, and here is how an MACD looks. It has two separate lines, which I'm going to explain in a moment. Then it has a histogram, and these are plotted against a central zero trend line, and they go up and down the trend line. Let's look deeper into this MACD graph, or the chart, or the oscillator, or the indicator, and how it is constructed. It is based on the principle of using two exponential moving averages superimposed on each other, and a third derivative, namely the space between these two moving averages, plotted as an histogram over a central zero trend line. How are these moving averages calculated? Your software should be able to give you an option to change the number of periods used for the slow moving average versus the fast moving average. Generally, they are set to 12, 26, and 9. And you can vary them based upon the manner in which your stock, bond, or a future behaves, and see how it helps you to identify the buy, sell, or hold signals. So let's look at, first of all, the green exponential moving average is called the signal line. It is made up of, in my case, I changed it to the Fibonacci numbers 6 and 13. So this is the average of 6 periods, and this is the average of 13 periods. It's a matter of which one fits the graph in the historical charts, so that you can predict future events in that particular stock or bond or option. The red exponential moving average is called the MACD line, and when these lines cross, that's when the signals are triggered. The difference between these two lines is plotted as a histogram represented as yellow bars here. And here we have 0, this is -2, -4, this is 2, 4. They can go, depending upon the height. Okay, what can we derive from this? Looking at the waveforms as we are seeing here, which I will get to in a minute. Looking for moving averages, convergence, and change in direction. Here we have the slow moving average crossed over by a fast moving average, and we have a crossover. So that is an important signal, and since it is towards the baseline and above, it is a buy signal. On the other hand, if the moving averages are converging, where the moving averages cross and the trend is going down, that is a sell signal. The moving averages above the trend line are on the upside of the market, and it is a positive trend. The bars below the trend line are negative, or the stock is moving against the main trend. The histogram is supposed to be most useful part of MACD. Prices moving up produce bars getting taller and taller above the trend line. Like as you can see, they're small, tall, taller, tallest. They're going up. The prices moving down produce bars which also have increasing heights based on the movement of the stock prices below the trend line that is in a negative market as all the averages are moving down, and the difference between these two averages is getting bigger and bigger before it eventually kind of plateaus and then begins to decrease. And when it is turning over, that is a very crucial point. As you can see, when the bars turn from downward swing to upward swing, we also see a corresponding change in the moving averages. The short moving average, the short period moving average moving above the slow moving average, and this is the crossover point. Keeping these things in mind, now let's look at a real QQQ chart and see how we can deduct what we have been talking about. Actually, this was taken from this QQQ chart, so it should be much easier for us to follow. This is the QQQ 60-minute, I think it's a 30-day chart. On February 16th, the market peaked, and from there we had a massive downward drift, downward movement of the stock price, and NASDAQ QQQ, I think, lost about 12% or more during this period. Our mission here is to see if MACD could help us to identify the direction of the stock market in terms of whether it is moving up or down. So let us start off here for the first time. As we can see, the bars were getting, from the downtrend, were getting smaller and smaller and smaller and smaller. And now we have the short-term moving average, which is 5 period, 13 period, and 9. I just changed it. Usually it is like 12, 26, and 9. And by clicking on this box, you can modify the numbers, you can modify the colors, and you can modify the thickness of the lines. That is from my software from Fidelity. When these bars are getting smaller and smaller, as you can see, the red line is crossing over the green line. That means now we have these bars flipping, and that corresponds to an upward movement in the stock market. And if you are one of the candlestick followers, you can see we have 3 strong soldiers. So that's an indication that the stock market is in a new uptrend. So if you follow the MACD and if you follow the Elliott waves, this may be a good point to enter into the market. And if you had entered the market here, you had a pretty good run up of a price from, say, here, which is 320 all the way to like 330, 10 points. That's pretty good. Then what happened is after the market stabilized, it had like a false signal here because it crossed over, but it didn't sustain. Then it just kind of came over and it was just kind of wandering around, which is not really helpful. MACD and most technical indicators are most useful when you have a wide swings and then wide reversals. Let's come back here and let's look at one major incident where it started. Like here, let's pick this one. This is a good one. And the bars were tall. As they were coming up, the red moving average crossed over the green line, and corresponding to that, we had a positive candle here, which is like a positive sign. And followed by that, there was some whiplash here. But other than that, for the most part, it continued to go up. So if you had entered the market here, you would have gotten from 318 to approximately 326. And this is where it crossed. But by the time you got, it would have been like 322, maybe 4 points at the most here. But nonetheless, it gives you some signals as where to get in and get out. We had a similar one here. And the most important question is, of course, this one, which I want to go over. As you know, on Friday, that was Friday on March 5th, we felt maybe we had reached a bottom. And did the MACD help us to identify that? In a sense, yes. As you can see, there was a nice, beautiful mount built here. The prices were going down and the bars were getting taller and taller. Then the bar heights gradually decreased. Then there was a sort of a seesaw appearance here. And eventually, when the bulls came in full force, the red line crossed over, and in fact the trend flipped to the positive side, and along with that it had 1, 2, 3, 4, 5 consecutive solid bars increasing in amplitude. So this is an indication of a clear-cut reversal of the trend in this particular region, in this particular price range. That doesn't mean the entire wave is reversed, but at least we have, just like in this situation and here, we have a reversal. We just have to see if it continues to get in the same direction, or whether it is going to have more fluctuations in the future. So this is telling us, and it is also telling us, that we have a pretty wide margin here, and it will be interesting to see what happens on Monday, March 8th, as to how far these bars. I would clearly follow these bars and see if the price changes become smaller and smaller, and if they flip over to the negative side, which may suggest a quick termination of this impulsive wave, just as we saw here and here. So that's how it helps us to trade on an intermediate basis. I'm not talking about day trading. I mean, it can be used for day trading, but this is more for like intermediate or long-term trading, where it helps us to identify points of entry and identify the points of bullish sentiment and price movement in the positive direction, and also point where you need to exit. If you don't exit, you run the risk of running a serious loss. This is a quick overview of MACD and how it can help us to identify the trends in the stock markets. It can also signal buy opportunities or sell opportunities, or it also helps you to see how long you need to hold on and watch for the changes in the stock prices before it flips over completely. Thank you so much for watching this presentation, and please do subscribe to our channel and watch number of videos we have on QQQ technical analysis, so that we become a more informed investor.